One. Today, we welcome back one of our favorite financial thinkers, Cullen Roche. He's a personal money manager, an economist, and author of numerous books, including Pragmatic Capitalism, What Every Investor Needs to Understand About Money and Finance. His portfolio of interests also includes home building, farming, and raising an adorable daughter. We are especially excited to speak with Cullen today because he has some big news to share with our listeners. Welcome back, Cullen.
Hey guys, thanks for having me.
Yeah, we're so happy to have you join us again. Before we get to your big news, we want to start with a couple of current event questions. Number one, what is your assessment of the state of the economy?
Um, so things look shockingly good. I often talk to people about, it's pretty crazy considering everything that we've been through with COVID, that the economy is as strong as it is. And, it's funny, I mentioned this on Twitter the other day. I asked people, was it good or bad the way we responded to the COVID, basically, with all the economic stimulus? And now we're kind of starting to see some signs of inflation, and it's not as transitory as the Federal Reserve expected it to be. And so there's kind of this raging debate. It was pretty interesting seeing the responses and how split people were, that basically half of the people thought that the stimulus was good and that things are great now, and so look, like, the inflation was just sort of the trade-off of avoiding a huge decimating decline. And the other half are basically like, no, look, the inflation is ravaging especially the middle class and the poor, and while some people are better off, it created more inequality and created more problems than not in the long run. So it's weird. Things look really good from a broad macro sense, and in a lot of ways it's really interesting, at least from my vantage point, because I kind of view the current trajectory of the economy as we kind of got put right back on the path that we were on before COVID. So it's almost like, rather than having this recession that really decimated things and caused kind of a financial crisis type of recovery, we basically threw a ton of money at things, and it put us right back on the trajectory economically that we were on in like the pre-COVID period. And so it's almost like we made the entire recession disappear, and we just have now nearing full employment, higher inflation, and this boom going on, especially in certain sectors like the housing market, where we're almost seeing, in some ways, almost like a blow off of like what was going on from that 2010 basically to 2020 trajectory. So it's a really strange economic environment. Things at a macro sense look, pretty good, very good, all things considered, where we were a year ago or a year and a half ago. But at the same time, I think we're starting to see signs that, like, the housing market is starting to slow some. We're starting to definitely see signs that prices have reached a point where a lot of people are pulling back and saying, look, this is crazy. I'm not paying this much for a house, or I can't pay this much for a house. So you're starting to see what I think are some likely signs of deceleration, certainly across housing. Nothing that looks like a recession again. So it's so weird to even talk about a recession, considering that we were just technically in one. But the way that I view it is that COVID was a lot more like a natural disaster than a real, typically recessions are caused by something booms, and then you have a sort of natural implosion. Like the financial crisis was caused by essentially a credit boom and a housing price boom that resulted in a bust. And so you had this kind of natural boom bust cycle that caused not a garden variety recession, but in terms of economics, a naturally forming type of recession. Whereas COVID was more like we were all just kind of humming along, and all of a sudden something came out of nowhere and just lopped us over the head and knocked us over. And so it was almost more like a natural disaster in that sense. And we're kind of back to where we were, in a sense, trend wise. But we're starting to see signs of that there was a little bit of a blow off top there, especially in the housing market, where you could start to see some softening in the coming 12 to 24 months, especially in the housing market, where the economy kind of, I don't know, muddles along, and not necessarily that we're going to get like a stagflation in terms of like a 1970 sense, but you could have this economy that feels a little bit stagflationary, and that you have real GDP that's like 1 to 2% and inflation that's pretty close to historical trend of like 3%. And that feels crummy to a lot of people, because it just feels like everything's more expensive and growth is low and, kind of muddling along in a sense.
Cullen, in regards to housing, this seems like, I mean, it's a problem, right? I mean, my son's 20 years old. He's going to school to become a teacher. My daughter's 13. She's gonna probably go to school to become a teacher. Dan's got young kids that are looking, that are gonna want to buy a home as well at some point in time. What are they gonna do? I mean, they're gonna spend $500,000, $600,000 on a starter townhome with high property taxes and HOAs. What do they do?
I mean, it's a really, really difficult situation, because the economics of the housing market are really, they're kind of messed up in the United States, in that we just don't have enough houses. I mean, It really, like, the problem is that simple. We have not had enough building in the last 20 years, especially, really the last 10 years, because a lot of this is still, in a weird way, we're still kind of climbing out of the financial crisis,
right,
in the sense that we had this big bust, and then a lot of the builders were really, really cautious to build more, and the banks were really cautious. The regulations got really tight, so all the lending now is super high quality, and so getting financing to do these big projects got a little more difficult, and the builders were just naturally more risk averse coming out of the financial crisis. And so you didn't have a lot of building in the last 10 years. And we're starting to see this sort of basic supply demand problem, where it's really hard to imagine this problem getting any better, just because building homes is a long process. It's become an even more expensive process. And so I don't have good answers. I wish I had, some good outlook for this going forward, and saying that all of our kids are going to be able to buy the homes they want to. And the simple reality is that the outlook looks really bleak right now. It looks like homes are going to be expensive for, the foreseeable future, certainly. And that the supply is not going to come on the market that's going to make a lot of things better. So I don't know. I wish I had some sort of good answer for this, but I don't. It sounds like our kids are going to end up being renters longer than they probably want to. And they're going to have to sort of probably settle for something that is not their dream home for a lot longer than, certainly our parents' generation probably did, and even us. So
okay, so on that happy note, let's talk about inflation. You mentioned that the Fed said it's transitory, whatever that means. I mean, I know what it means, but what's the deal? Because this feels like the biggest question that I keep hearing. Clients keep asking me. Everybody's talking about inflation as it relates to their fixed income portfolio. They're losing purchasing power, their pensions, especially teachers who retire on a pension that doesn't have a cost of living adjustment or a very small one. Is this something that we're just going to have to deal with for a couple years, or is this something that is going to be long-term? Is this something that gets solved, or is this something that's going to start decelerating?
Well, it is, with the exception of housing. This is something that the old economic saying is high prices. The solution to high prices is high prices. Right. And in a lot of markets, I think that's going to end up being totally true. Like you're seeing lots of weird things that happened post-COVID, like this, all these ships that are sitting offshore in LA, and, like the lumber price boom. And there's a lot of the used car thing. you've seen a lot of sort of acute price increases that I think they aren't looking as transitory now as the Fed expected them to look. I think in the long run, meaning like the next like 24 to 36 months, I think these things are they're going to end up looking a lot more transitory than a lot of people maybe expect. I don't expect a core inflation rate of 4 to 5% to persist. I would expect that to drop back down into something like the 3% range in the next few years. So yeah, a lot of this is looking like it's not transitory now, but I have a feeling if we were to talk in 2 years, I think that people will look back and say, that it looks more transitory than not. And that whole word, I hate even using that word. I've talked about this on my website. Yeah. The word it's a really bad word for the Fed to use because most people view inflation just in a totally different way than economists do. And most people see it as something where, like, if you know that a gallon of gas costs $3 and that the price of that gallon of gas goes up to $4, well, you kind of know that the likelihood of that price going back to $3 is probably not that high. Okay, so, but in an economic sense, if the price of that gallon of gas just stays at $4, or even if let's say it goes to $4.25 in year 2 or year 3, well, the Fed actually would call that transitory because the rate of change has changed. So year 1, it's a 33% increase. Year 2, when it goes up to $4.25, it's like a 5% change or whatever the math is. So it's, in an economic sense, it's transitory to a central banker because the rate of change has slowed so much. Whereas most of us say, no, I'm just paying, $1.25 more for gas. I don't care what the rate of change was. All I know is that I'm probably not making 40% more than I was 2 years ago, but I know that a gallon of gas costs 40% more. And so the way they communicate this is really messy and bad. And I've noticed a trend in the last month where a lot of Fed economists are actually coming out talking against this word and saying, explaining that they shouldn't use it. I think one of the central bank presidents came out and said that I think this was 2 days ago, they said that the word transitory was a swear word in their office now. So that's at least a good start for communications. But yeah, I mean, it's just not a very good way to communicate the concept. And again, going back to the original, debate about whether or not all of this was good, was we threw $6 trillion at this thing in 2020. And so the question for everyone is, is it worth all of this? If we assume that there was this one-time sort of big bump in prices that is going to, at least moderate to some degree. Let's say we had an overall, 5 to 10% jump in overall prices that's going to moderate to like a rate of change of like 3% going forward. Well, was that worth it relative to having what could have potentially been a really devastating recession? And, again, that's a super messy debate, and everyone's perspective on it is going to be a little bit different. And so I don't know what the right answer is there. I mean, my view is that looking, with the benefit of hindsight, I think we dodged a humongous bullet here. I mean, especially like we all have kids, and I always say this to everybody I talk to, this thing didn't kill children. And if this thing had been killing children, because the Spanish flu killed a lot of children, and it decimated 1% of the entire population back then. If we had lost hundreds of thousands of children during this, I mean, holy cow, this thing would have been, I know personally, I wouldn't have left my house. I absolutely, if I knew that the risk of if there was a really significant risk of me exposing my daughter to a deadly virus, you guys wouldn't have seen me you still wouldn't have seen me anywhere in public. So, and the economy in that situation, I mean, we talk about government lockdowns, there would have been self-imposed lockdowns in that scenario that would have been nightmarish, because you wouldn't have been buying anything. I mean, you wouldn't even have let an Amazon delivery person walk up to your door in that situation. So I don't know. We dodged a huge bullet. It's easy to look back in hindsight and say, oh, we did all the wrong things and we did too much. And, yeah, I mean, yeah, I did actually say that the later stimulus packages were probably too much, but I mean, all of that was the benefit of hindsight to some degree. And so, I don't know all the right answers to all this, but looking at things now, it's in a lot of ways, it's sort of amazing that, we're even talking about a growing economy and inflation in the first place.
Wow, I really enjoyed that answer, Cullen, and I agree with you. I feel like, when we look back at this 10 years from now, I believe we're going to have the conclusion that it was better to do maybe a little too much than not enough. It's easy to be blasé when you don't end up in a car accident, right? You miss that accident and you think, oh, everything's fine, but the consequences would have been devastating.
Yeah.
This is a little bit connected, and this will be the last question before we get to your big news. What is your perspective on the debt ceiling debate? Because I follow you on Twitter and I enjoy what you say there.
I mean, the whole thing is just, it's really frustrating and silly for me at this point. So I actually, I've been writing about the silliness of the debt ceiling concept for 10 years. And so the way to think about this is that the debt ceiling basically it's a fake limit on the amount of debt that the country can issue. And what happens essentially is that Congress debates how much they're going to spend in a given year. And the debt ceiling is already in place at a certain limit there. Okay. So we debate about how much we're going to spend. We all agree in Congress that we're going to spend, say, $1 trillion. And then in November or December, we realize for some reason, we remember that the debt limit only allowed $750 million or $1 billion or whatever. And so we end up reaching this debt limit. Even though we allocated $1 trillion of spending, we end up reaching this credit limit. And so in a really weird way, it's a lot like a credit card company that has its own credit limit self-imposed on itself. And in the process of having this credit limit, allocates spending that they know will breach that limit at some point in the future. And they have this internal debate with themselves saying, hey, should we raise this credit limit on ourselves or should we not? And then they all, they go back and forth and they grandstand and they have this big political charade. And then they say, okay, let's go ahead and raise this credit limit, And so look, the US government it's an entity that can literally print money. It doesn't have a strict credit limit. Like there is no strict credit limit on how much money the US government can spend. And so this whole concept of imposing a credit limit on spending and then appropriating the spending and going through the whole process of then having to, raise the debt limit in the future, it makes zero sense. We're one of the few countries with this self-imposed credit limit. And as long as, look, I get both sides of the argument. If you want to have the debate about being more fiscally prudent, that's fine. But the time to do that is not after you reach this credit limit. It's having the debate before you decide to spend the money that's going to inevitably need to result in the financing that will, by necessity, result in breaching the debt limit and having to raise this credit limit in the future. So look, if you want to have that discussion, do it in Congress at the time you actually appropriate the spending. Don't impose this debt limit that you then inevitably reach and then results in, bond market turmoil and government shutdowns and all this disruption and back and forth that just is frankly just a big waste of time and energy. And then you see, like the worst part about this is that you start seeing all these silly responses to it. Like, we keep talking about in the media, this $1 trillion coin. And it's like, we have a silly problem that we're now, serious people are debating silly solutions to solve this silly issue. And it's like, what are we doing? Do we hate ourselves or something? Why do we keep punching ourselves in the face over this stupid issue?
What? So even though it's a silly idea, doesn't it just make sense to get past the debate and just be like, fine, we're not even going to deal with you taking, holding us hostage. We're just going to mint this coin and move on. Does that, like, I realize that's dumb, but like, so is this whole thing. And it used to be that I didn't really see this very much on the left. Most of the time, the left was like, yeah, this is dumb, we're going to raise it. But then over the last 4 or 5 years, I've started to see more people like, hey, let's use this as leverage to negotiate for something, which I get.
Yeah.
But then they're going to, as soon as they start using it for leverage, the other side is going to want to do the same thing. And right now we're seeing that, but to like this is the first time I've ever thought, oh, these people aren't cosplaying. They actually are going to do it. Just like in Veep. I don't know if you watch Veep. Did you ever watch the show Veep? Yeah. Well, Jonah voted against raising the debt ceiling, and it was a complete disaster. And like, I feel like there's some Jonahs in Congress now that could take us to the real edge, and maybe on both sides. And so, like, I kind of feel like we have to have the $1 trillion coin in our back pocket, regardless of what party you're from, because someone's going to just do something stupid because they want to see the world burn.
Yeah, I mean, I guess maybe I'm very naively optimistic about the world in general. So there's this part of me that just sits back and says, there's no way we're actually going to default. Like they're not that stupid. There's no way they're going to actually let that happen. And, but then I guess there's the risk that, I don't know, there's a lot of stupid people in Congress. So like maybe this is more of a risk than I actually think. But I mean, I would like to think that, we would at some point just reach the conclusion that, look, this whole thing has gotten beyond silly. We should recognize that the debt ceiling is not really a constraint. Like, this thing's obviously not, like, people used to write me and say, no, the debt ceiling makes sense because it imposes fiscal constraint on some people. It makes people think about how much government debt we're going to issue and whatnot. And I'm like, well, okay, that used to sound like a reasonable argument to me. But here we are, 10 years after I've been writing about all this and getting these responses. And like, Trump issued how much? $8 trillion in the national debt. Biden's going to do, who knows how much more. Neither party is really having a serious fiscally prudent debate about all this stuff. So I don't buy it at all that this is actually a credit limit in any meaningful way. And so I just don't, what's the point of having this thing? So if the coin is a tool that gets us to eliminate the debt ceiling, then I guess that's a reasonable response and a reasonable way to get to that end result. But I would hope that we don't have to resort to these like silly loopholes, in the law that force the other side to come to, a practical conclusion.
Okay, so moving from the silly to the serious or to something really super cool. When we reached out to you to have you on the podcast, we wanted to talk about all this fun economics and inflation and interest rates, all that stuff. But you actually responded with some news, and which we think is really cool. So let's switch to that part. So what is the big news? I think, what was it, like earlier in September or late September, something kind of really neat launched. Tell us about it.
Yeah, so September 21st, we launched the Discipline Fund ETF. So if I look exhausted, and the reason I'm wearing a hat is because I haven't had a haircut in like a month. So this whole process has been basically consuming my life for literally the last year. So I called Wes Gray at Alpha Architect about it. It was last December, and Wes runs a firm that operates a number of ETFs, but they also have a white label ETF issuing arm that they help people basically launch ETFs. And so I've had this idea bouncing around in my head for 10, 15 years that I wanted to start a publicly traded fund, but I wanted it to be something really useful for people. And and you guys kind of know my ethos that I'm a big advocate of low cost indexing approaches, getting people to really focus on the things they can control, which is basically their taxes, their fees, their asset allocation, and their behavior. And increasingly, my experience over time has been that behavior is really the primary determinant in how people are able to generate good returns over time. It's not about finding the smartest asset manager or timing the market. It really is about finding a strategy that's appropriate for you, that you can stick with through thick and thin, and that ability to stay the course. You know, John Bogle used to always tell people, stay the course. That's the key to generating good investment returns, is finding something that's behaviorally appropriate for you, that has a good probability of meeting whatever your financial goals are, and just stick with that strategy through thick and thin. And, you know, we benchmark ourselves to all of these silly things like the S&P 500 or our neighbors. And, you know, you hear all these anecdotes about how so-and-so generated XYZ return. And, oh my God, you know, Joe Schmo bought Bitcoin, you know, 3 years ago and is up 10,000%. I wish I had done that. So now I'm going to go turn over every, you know, stone in the crypto universe so that I can become that person. And so often doing all this stuff and chasing these narratives and these stories, it ends up resulting in people just taking huge amounts of risk that are behaviorally inappropriate for them. And they end up underperforming a counterfactual where they had done something that was just very, you know, evidence-based and discipline-based, that in the long run would have generated better returns for them. So that's kind of the whole ethos that I was really working with, trying to develop this fund. And we ultimately arrived at, I built a very, I don't want to say it's exactly like a Vanguard type strategy, but it's similar in that I am essentially using a whole bunch of Vanguard type index funds in the underlying, but it's a fund of funds that's designed to provide people with enormous global stock diversification, very high quality bond allocation. So it's 10,000 plus underlying holdings. So a crazy diverse fund, gives you global access to the stock market, gives you very high quality bond allocation across thousands of different high quality investment grade and government bonds. And the kicker is that it rebalances more dynamically than your traditional index fund. And the goal is to create something that's sort of behaviorally insulating you from doing the wrong things at the wrong time. So it's literally designed to help people try to stay the course. And the way that we basically do that is that it rebalances somewhat countercyclically, meaning that, so your traditional index fund, for instance, let's just say that it's a 60-40 stock bond index fund. Well, that fund typically, it will grow into like a 70-30 over the course of a stock market boom. And what Vanguard would do with a 60-40 is they'll just always rebalance that thing back to 60-40. And this is a great product. I love 60-40. I love like target date funds. I love any low cost indexing approach. But the risk with something like that is that a 60-40 or any really balanced index fund, it exposes you to different degrees of principal risk across time. And so 60-40, for instance, it falls 35% in a year like 2008. It fell 30% in March of 2020. That's a pretty hefty decline for something that is referred to as a balanced index, because the risks in that fund are not really very balanced at all. And so it triggers this risk of behavioral response that could result in people making mistakes at times. And so what I'm doing with our fund is it's rebalancing in a more counter-cyclical sense, meaning that, for instance, rather than always just systematically rebalancing back to 60-40, like right now, my fund is a 45-55. So what it's basically consistent with is an environment where the stock market has been through this big boom, and it's rebalanced in a way that is basically saying, look, we should stay the course, but we should trim our equity exposure, our stock market exposure, so that we're insulating ourselves a bit better from the potential that if the stock market were to go through a big decline after this big boom, that we would be better behaviorally insulated from making a mistake. And conversely, it does the opposite. So in periods like March 2020 or during the financial crisis, the portfolio rebalances in the other direction. So it's always doing something that's a little bit counter trend or a little bit counter, to what the predominant trend is in the market, what most of us feel like we're oftentimes getting sort of lured into, which is typically when the market booms, we're getting lured into, feeling like, oh, we've missed out. And maybe now's the time that I need to, go all in on the stock market. And why do I own bonds at all? And oftentimes that ends up being the exact wrong behavioral mechanism. So a lot of what I'm doing is just really, working from an evidence-based and first principles understanding that, look, we want to be really diversified. We want to keep our fees low. This thing is super tax efficient because it's fund of funds inside of a single ETF. So it rebalances internally, which means it doesn't kick off capital gains when we rebalance. But we're also applying this behavioral element where I'm trying to help people literally behave better. And it's called the discipline fund because I'm literally trying to instill discipline in people across time.
So for listeners, if they don't know what an ETF is, it stands for Exchange Traded Fund. And that's basically, it's kind of like a mutual fund that trades throughout the day. But we're actually going to get to mutual funds versus ETFs in just a bit. How is this? Okay, so two things. One of our, next to Cullen Roche, one of our other favorite writers is Morgan Housel, The Psychology of Money. Your approach sounds very similar to his approach. Same thing. He says the same thing about behavior. It's what behavior that matters, not necessarily your returns. How much money you're putting in and your behavior. And what would you say about? So it sounds like with this countercyclical. How is countercyclical investing different than market timing?
Well, I mean, this gets into really, like debates like the active passive debate. And I always tell people, look, everyone's got to be active to some degree. Everyone deviates. So there's one true passive portfolio in the world. And that's if you were able to go out and buy all of the world's global financial assets. It's the only, if you were a true efficient market theorist, that's the portfolio you would buy. And guess what? Nobody can buy that portfolio because it's not investable. It's literally not investable. You can get close. You can buy a lot of stuff. Like I put together what's called the global financial asset portfolio. And sometimes I post it on my website and on Twitter and stuff. But even that portfolio, it was interesting going through the regulatory process because the SEC and a lot of the attorneys we work with, they were coming back to me and being like, what is market cap? You're referring to this as market cap weighting, global market cap weighting in your equity sleeve. What does that mean? And I'm like, well, it's just jargon because nobody actually quantifies this correctly. Because literally, like if you look at Vanguard Total World, it's pegged to the FTSE 100, the FTSE 100 All World Index, and the FTSE All World Index, it literally doesn't own the whole world. It owns like 50% of global equities because the rest of it's not investable. So you get into these debates and people ask me, isn't this just an active strategy? And I would say, yeah, of course it is, because everybody's active to some degree. And there's really stupid to be active, like day trading and doing things like that. And there's smart ways to be active, which is like all of what we call passive indexing is something I would call smart active. In that, like I was referring to the 60-40, where 60-40 grows into 70-30. And what does Vanguard do? Vanguard chooses actively to rebalance it back to 60-40. That's great. There's a lot of great aspects to it. And there's nothing wrong with that level of activity. I would argue that, my fund is a little bit more active because we're choosing to basically more actively rebalance. Is that bad? It could be. I would bet that in the long run, my fund will underperform 60-40. I'd be willing to, if somebody wants to make a bet with me for millions of dollars about that, I'll bet that my fund underperforms 60-40, which is a crazy thing to say, but it's just math. On average, I'm probably going to be less aggressive than the 60-40. So on average, my fund perform that allocation, which is, that's part of what I'm trying to achieve, though, is that I kind of know that by taking less risk, I'm hoping to instill a certain degree of better behavior in people. So, investing is so personal and so customized that we all end up having to be active, and we have to make these hard decisions about how we're going to be active. How are we going to contribute money? When do you lump sum? Do you dollar cost average? When do you withdrawals? When do you rebalance? All of these decisions are active to some degree, and they result in portfolio changes that we have to be thoughtful about. And that's the kicker, is that you have to be really thoughtful about how you actually implement these changes, because they are necessarily active, but there's smart ways to do this. And my view is not that my fund is, like some world beating, S&P 500 beating type of index. It's that for certain people, this thing is going to be very behaviorally appropriate. And yes, it's technically an active fund, and it's more active than a 60-40 index fund. But for a lot of people, being as inactive as a 60-40 will create behavioral biases and behavioral risks that might be inappropriate. So, is it active? Yes. Is that necessarily bad? It depends.
So hey, that's the name of the blog I keep telling Dan I'm going to create is It Depends, because every time Dan asks me a question, I said, well, it depends, and it drives him nuts. So I mean, essentially what you're saying, I think what you're saying is, listen, if you're the kind of person who's going to get into a 60-40 portfolio and then there's a big drop and you sell out, then doesn't matter what the long-term returns of that 60-40 portfolio are.
Yeah.
And so the discipline fund is there to help you kind of drive through those emotional times and just leave it there. This fund will do what it's supposed to. It'll rebalance counter-cyclically. I guess it's going to attempt to buy high and sell low, but it's really going to attempt to take more risk when prices seem lower and less risk when prices or maybe valuations seem higher. Is that mostly accurate, or?
It's tied to not only like market valuations, but also more importantly, it's tied to macroeconomic factors. So a big part of what I'm trying to do is to some degree hedge your actual financial portfolio from the economy to some degree. So one thing that we ignore in our financial portfolios is the fact that when the stock market falls a lot and we go through a recession, these things tend to coincide. So one of the worst parts about a period like the financial crisis in 2008, 2009 is that your portfolio is falling and the economy is getting tougher. So people are losing their jobs, and you've got this sort of, dual negative shock that's going on in your life, where if you're someone who lost your job and your portfolio fell, well, you have a big problem, because you can't afford to take a principal loss inside of that period. If you need liquidity because you've lost your job in a period like 2008, well, you basically have to, and let's just say you're all stock market allocated, you have to take a principal loss, which from a portfolio management perspective, it's the absolute worst long-term thing to be forced into doing. A forced liquidation is one of the worst things that can happen to somebody. And so that's one of the risks that I'm trying to help people avoid, is that essentially we're taking less risk in our equity piece in the portfolio and in our overall portfolio when the economy is booming. And so the way that I'm implementing this thing for people is that I'm applying a very specific bucketing approach. And so what I'm typically doing with people is that, for instance, let's keep this really simple. And, to me, like the most beautiful portfolio in the world is something like a 3-fund portfolio, where you've got 3 sorts of buckets, where let's say that you've got like you need a liquidity bucket or an emergency bucket, and then you've got sort of a medium term, moderate, aggressive bucket, and then you've got long-term money that's a very aggressive bucket. And you could take 3 funds, like you could take like Vanguard Corporate Intermediate Fund, you could take the Discipline Fund, and then like Vanguard Total World. Literally 3 funds, the overall portfolio cost is like 20 basis points or lower. And what you've got with this thing is you've got 3 very specific temporal buckets that psychologically and economically provide you with pretty much all of the financial needs that you have within your portfolio, where you've got a liquidity bucket, where if you're taking withdrawals or meeting short-term, liquidity needs, let's say you're thinking about buying a home in the next 3 to 5 years, even though most of us can't afford to buy a home ever again. You've got this bucket though that gives you a short-term bucket. The discipline fund is there to rebalance in a very tax efficient way that gives your overall portfolio a huge amount of diversification. And that's sort of that's the bucket that you just don't worry about. You just let it do what it's going to do. It rebalances internally. It helps keep your risk profile consistent. And then Vanguard Total World or something like that, your aggressive bucket, just let that thing run wild. It's going to do what it's going to do. It's going to fall 50% sometimes, whatever. Don't sweat it. Just let it ride in the long run. And implementing this sort of approach, you've basically covered all your bases to a large degree. And you can mix and match these three buckets in any sort of way that is personally appropriate for you. But you've kind of covered all your bases there, where you've built something that's very low fee, tax efficient, and super diversified, but you're meeting all of your liquidity needs and your temporal constraints. And you're bucketing this in a way that, to me, from a sort of behavioral finance perspective, you've covered all of your bases from a behavioral perspective, because you sort of know, okay, I've got money short term that I don't need to worry about. I've got this medium term money that, it's not going to worry me too much across time. And then you've got this long term bucket where that thing worries a lot of people, but behaviorally now you've segmented that thing in a way that you just let it ride, let it do what it's going to do. And you might look at that thing and it might scare the hell out of you sometimes, but behaviorally, you've got these two other buckets that are much more secure that you just don't have to worry about too much. So that's sort of the way that I'm implementing this. And it's just to me, it's a very simple and yet somewhat sophisticated approach to being able to do all this that covers not only your asset allocation needs, but it's a very financial planning based foundation in terms of covering, all of your abilities to meet these liquidity needs that you need across time.
Where can someone invest in this fund?
So it trades like a stock. So, we launched it on the New York Stock Exchange. And so anyone can buy it inside of their brokerage account. And so it's Schwab, TD Ameritrade, any of these big brokerage firms will offer the Discipline Fund. And the website is disciplinefunds.com if people want to research it. I'm more than happy to answer questions about it and help people kind of navigate, is this thing even right for me? Is it something that I can utilize in my portfolio? But the one kicker is with actually buying and selling this thing, because it does trade like a stock, I'm always telling people, if you go in and buy this thing, use a limit order, be careful with it, because especially with some of these newer issue ETFs, they don't trade very much. So you have to be a little bit careful the way you actually buy and sell these things, because you don't want to put in a market order and buy this thing way above the actual value of the underlying assets, which can happen at times if you're not careful. So, but I've literally walked people. I helped a retail investor with $15,000 last week, walked him through a trade, helped him, work with his broker to get a better price. And so, a lot of this is just, for implementation purposes, because these things trade like a stock and, not like a mutual fund where you generally just put in a dollar amount and you buy that amount at the end of the day. These things you have to be a little bit more careful of, because they trade like a stock. They can, you have a potential for like trade errors and stuff like that, which you just don't want to mess around with stuff like that, because you end up, mispricing your asset allocation from the beginning.
Yeah, so I'm super excited about this, especially for a lot of our listeners where we can't, we don't necessarily, we don't manage money for them. So they have an option like this, I think is amazing. I can't go into their 403B at this point. Some ETFs are allowed in 403Bs, but you got to do it through a self-directed brokerage account, which is generally not offered. I'm hoping that in the future ETFs will be allowed and become much more prevalent in 401ks, 403Bs, 457s, and then we can start pushing to get this fund, this exchange traded fund, added there. Otherwise, everybody can just go open Robinhood, and I'm joking. So, I'm super excited about this fund. When you told me about it, I was like, oh, this is This is great. I always kind of wanted to see, how Cullen did things in his own practice, and I think this is a great way for people to get exposure. So we're not giving investment advice on this program, but I think our listeners should definitely go to the website and see if it's something that is right for you. And that's kind of a perfect segue into mutual funds versus ETFs. I don't want to spend a lot of time on this, but I keep saying that I think my kids or grandkids, at least my grandkids for sure, are going to look at mutual funds like my kids look at rotary phones. They'll be like, what's that? What's a mutual fund? What is this clunky technology that you guys used to use? What's a mutual fund? Maybe I'm just being overly optimistic or something, but I mean, ETFs are just a better vehicle than mutual funds. Do you see? Oh, and that brings me. You just wrote about this from an article from Bloomberg. I'm going to say his name wrong, but Nir Kassir. He wrote about this. Do you think it's just a matter of time before exchange traded funds, for the most part, completely replace mutual funds?
I do. I'm actually, Nir mentioned this, that he was surprised it's taken this long, and I am too. But you guys know how it is. The retirement planning space is still completely captured by the mutual fund industry.
Yeah.
And so they just sort of have this stranglehold on things where they've made it very hard to replace them inside of these vehicles. And so in the long run, we're starting to see this where a lot of these big mutual fund companies are actually transitioning. They're converting a lot of their mutual funds into ETFs. And, without getting too deep in the weeds, it depends. For a lot of retirement plans, the difference is probably not that material, just because one of the big benefits of ETFs is the tax benefit of it. That
Right.
With a mutual fund, for instance, like if you trade a mutual fund in a taxable account, you could buy a mutual fund in December of that year. And the way that a mutual fund works basically is the mutual fund takes in cash, and the portfolio manager has to reallocate the portfolio when they take in cash. And so when they do that, they take in cash and they have to buy and sell things. And when they do that, they incur capital gains across the way. And they don't pay those capital gains. They kick them out to their shareholders. And so an ETF works differently in that, without getting too deep in the weeds on the mechanics, an ETF avoids the capital gains distributions because the shareholder is not the one. So when somebody puts money in the discipline fund, I don't change anything. I don't go in and allocate money to the underlying Vanguard funds or anything like that. The actual market makers are the ones that are doing the buying and selling underneath in their own books. So they might incur capital gains in the process of what they're doing. But what they're doing is they're just selling you a share of the ETF that reflects the value of the underlying assets that they're buying and selling. But the kicker is that what they're doing in this whole process is they're giving you control of the capital gains. So unlike the mutual fund, where the mutual fund kicks out a capital gains distribution in December, you might have just bought this thing and you get, even though you don't actually have a capital gain, you could get hit with a capital gains distribution, which is crazy. It's unfair. It's the result of other people's, problems, basically, good problems in the case of paying taxes usually. But you're incurring this sort of unfair distribution as a result of other people's actions. ETFs are more equitable. They're just a fairer type of vehicle because they allow you to avoid that. And so they help people control their capital gains by giving you the power of incurring a capital gain when you actually buy and sell the fund. So ETFs don't avoid taxes, but they help you control the actual distribution of the capital gains by allowing you to control when we have these distributions based on when you actually buy and sell the fund. So that's the biggest advantage to an ETF. This advantage obviously doesn't exist in a tax deferred account. So it kind of depends on whether we're talking about tax deferred versus, tax advantaged or taxable accounts. But, for practical purposes, the ETFs, I think, are going to, in the long run, dominate the investment space because people want these vehicles that they're more liquid, they're more tax efficient, they just operate more efficiently the way that they actually price things. Like mutual funds, for instance, even in a retirement account, the mutual fund is less efficient than its ETF counterpoint part, because the mutual fund ends up always holding cash to some degree because it has to make these distributions and it has to, rebalance. And so the ETFs are they're slightly more efficient in almost every way when compared on an apples to apples basis. So in the long run, I would be shocked that if the mutual funds, continue to hold as much of the market share as they currently do. But I don't know, I've been wrong about how fast this was going to occur for the last 10 years. So it seems to be moving a lot more slowly than I would have expected. But hopefully things are starting to kind of change pace here. And we're, especially in the 403B and the 401k space, I'm hoping we start to finally see some big trends and people really are starting to, shake these trees and force some change that get these better, more efficient, lower cost, vehicles into these plans so that people can, operate with vehicles that are just so much more efficient for them, better for the end user in almost every way.
We couldn't agree more with that, right, Scott?
Oh yeah, 100%.
Colin, let's shift gears a little bit. I have a few questions. I want our audience to hear your answer to a question you recently addressed on Twitter. The question is, what prevents most people from building wealth?
Oh man, I mean,
Is it behavior?
It is. I mean, I think, I said enough, which is, I mean, kind of a generic answer to some degree, but the question said, you do answer this question in one word. So unfortunately, you could write, I mean, John Bogle literally wrote a book about the word enough. It's titled Enough. It's a great book if you haven't read it. But yeah, to me, I mean, that is a big part of what I think a lot of people struggle with is that we're constantly benchmarking ourselves to these unrealistic benchmarks of our neighbors and our friends, or the S&P 500, or, how much Bitcoin is up, and these things that are just very unrealistic. And I think, I've always said that the most important financial question that anyone can answer for themselves is figuring out what is enough for you, because it's really hard, especially during times like now where a lot of asset prices are booming. It's very hard to look around and say, and inflation is kind of rising, and say, I feel like I don't have enough. And that's sort of a perpetual human worry, is we always kind of feel deficient in a lot of ways. And, the clients and the people that I work with that are absolutely the happiest are people that I think have sort of, to some degree, they've succumbed to this reality that the grass is always greener somewhere else. There's always somebody with more. Even when you get to the point where you've got a great big boat, there's always somebody with a bigger boat. And if that person doesn't have a bigger boat now, somebody is building that bigger boat. And so, I think a lot of people can get caught in this sort of hamster wheel where they're just constantly chasing something that they think will feel like enough at some point in the future. And the reality is you just always kind of feel like you just never have enough. And so in a weird way, you just, more is less in a lot of ways. And so to me, building wealth obviously is a really tricky thing, in the sense that I think a lot of people, especially from a financial market perspective, they also do this the wrong way. They think that when people are actually investing, people think that they're building wealth in the stock market and things like, the crypto markets. And really, I always try to reposition people and say that, look, the right way to try to build wealth is to don't invest in Bitcoin and the stock market thinking you're going to get rich. Invest in things like getting smarter, learning to behave better, trying to learn from your mistakes and doing these things that, educate yourself and doing things that will make yourself more valuable to other people so that you can then be valuable to these people in a way that you generate a higher income, which helps you to save more and then allocate that savings into things like, the financial markets where you can protect your wealth. But those aren't the places where people necessarily get rich. I mean, the place where people get rich is building your own skill set that allows you to become more valuable to other people. And that a lot of people get that backwards. And so building wealth obviously is a really tricky thing, but that's kind of a general view of where I would start for most people.
So it's not just putting all your money into Bitcoin or Shiba Inu.
Yeah. Right.
I love this mention, Cullen, of the importance of human capital. I have a 23-year-old daughter who just graduated from college. She's about to move to area I think well, Washington, D.C. for her first job. And we've really tried to emphasize this focus on continue to learn, continue to, grow. I got a question for you from a person that Scott's already mentioned here, Morgan Housel. This is one of his favorite questions. I'm going to steal it. Cullen, what is something you have changed your mind about? He's all doing this pod.
I mean, gosh, being in the financial markets, I feel like you're just constantly changing your mind about the way things work. I used to sort of pigeonhole myself into picking sides. And I think a lot of people do this. And, one of the things that I've really changed my mind about especially in the last 5 years, especially with the political climate the way it is that I've really changed my mind about the way that I sort of pick sides on things. And I go out of my way now to try to understand the other side of arguments, because I've sort of realized, especially with the Trump presidency and the way that the country was so divided over everything there, that it kind of dawned on me that, there's got to be, there can't be tens of millions of people that on both sides that are just totally irrational about everything, right? I mean, there's got to be some sense to the views on both sides of these things. And I think part of the problem is that a lot of us don't ever make the effort to actually try to understand the other side of the argument. And even if the other side's argument is nonsense to some degree, it's so illuminating and educational to understand, put yourself in somebody else's shoes. And so in the last 5 to 10 years, I've really gone out of my way to sort of change my mind about the way that I sort of team up with certain sides of certain arguments, and really have tried to, be a little bit more, I guess, centrist or down the middle on things, and not, sort of understand that the world really we live in a very gray area in terms of everything. And it can be really, I think, helpful to, see the black and white on both sides so that you can understand the way that all of this is complex. Because, I mean, the world is just a really, really complex, intermixed place where very rarely do I find that somebody on one side of an argument has everything right about that argument. And so that's probably in the last 5 to 10 years, the biggest thing that I've changed my mind about, where I used to, I'm a weird bird in that I graduated from college and I was very sympathetic to libertarian sort of Milton Friedman type Hayekian Austrian econ types of views. And then as I got further along in my sort of financial and economics education, I sort of realized, well, a lot of that's just nonsense. A lot of it is politics. And I kind of veered in the very opposite direction. And over time, over the sort of the last 5 years, I've sort of realized, there's some sense in both of these views, but both of them are also wrong in certain ways. And so I've kind of done this round trip where I went way right and then way left. And now I'm kind of in the middle. And it's I try to understand both sides of the arguments.
I just love that answer. And I'm going to try and incorporate more of that type of thinking because I feel like I've been on a similar journey that you just described. But I really appreciate that. My last question, and it's another tweet, and it really, I feel like it speaks to me. The 3 stages of housing. This apartment is too small. This house is too much work. This apartment is just right.
I mean, I feel like you just described life. Like that's just like the the cycle of life, right?
Exactly.
But it goes back to that whole concept of enough. I think that a lot of
Yes.
people, and I'm just to be clear, I am deep in the weeds on segment 2 there, where I am, I just built this house. I broke my back. I literally nearly cut my head off 2 or 3 times during the process of this, trying to cut down my own trees and stuff on my yard. And
I thought that was going to be your answer on what you changed your mind on. The house, building the house.
So I'm deep in the weeds on part 2 there, where I'm slowly realizing, like, I was pulling weeds over the weekend for like 2 hours, and I was like, this is awful. Why am I doing this again? But no, I mean, that's sort of it's part of figuring out that whole, what is enough. And it's, again, I've made a lot more mistakes than most other people would, especially with building a house. But it's just part of life that I think we go through these ups and downs of realizing, figuring out what is enough. And some people never figure it out. But yeah, I mean, I think ultimately we all end up, or most of us end up at some point in our lives realizing that, the things that are really important in life is not the stuff that we have as much as it's I know it's a cheesy answer, but it really is about the friends and family and, the people around us and the relationships that we have and the quality of those relationships. And money doesn't fix all that stuff, and having more stuff doesn't fix all that. It can make it easier in certain ways. But a lot of people lose sight of, the balance there. And that's part of the whole, the whole path of figuring out what is enough for somebody is a part of to some degree making the mistakes along the way and sort of learning, but not losing, you just don't want to lose perspective about those things. And, I think hopefully COVID put a lot of those things in perspective for us about the things that are really important and especially the people that are important to us. So yeah, I'm close to the point in my life where I'll probably be moving back to an apartment soon. So
Scott and I have this debate all the time, and I've got, a daughter moving out of the house. I have a son who's 17. We can see this sort of childless, living at home life. And I relish the idea of the downsizing. Smaller, less is more, gives more time. I can't wait for it.
Totally. I mean, I don't know. I mean, there's a lot of, I drove a Bobcat through my house, which was awesome. And literally I rented an excavator for, 2 weeks here. And yeah, I did some crazy fun stuff. So there's, I don't want to say that there's not huge, benefits and upside to home ownership and things like that. And it's certainly for people at certain segments of their lives. But yeah, there's a lot of truth to the idea that less is more and the flexibility that it gives us. And so, yeah, I think you guys are totally right.
Well, yeah, I spent last weekend fixing a toilet, fixing a sink, fixing something, putting in a new stove. And then Monday rolled around and our patio lights all went out. I have no idea why. And my garage door just randomly stops at random places. And I just have to keep, trying to fix it. It's like, it's never ending. And I'm like, oh my gosh, I remember my dad saying the exact same thing to me, man, it just never ends.
It's hilarious. I mean, with homeownership, I always say, that I wrote a whole section in my book about how a house is not an investment. And the big kicker with that is that there are all of these underlying costs to homeownership that, I kind of wonder to a certain degree that, are our kids and younger generations just smarter in the sense that they've sort of realized that, yeah, there isn't necessarily the financial upside of homeownership, but renting is so much easier in so many ways, and the flexibility that it gives you that, I don't know. I mean, the rent versus buy question is always a really personal, really difficult one, but there's all these hidden costs in homeownership that people just don't fully account for. And people tend to remember the price that they purchase their home for and the price they sell their home for, and they forget or block out all of the bad memories about the 3 hours you spent taking your toilet off and replacing it over the course of time, and the thousands of events like that went on they had real costs, not just in terms of time, but a lot of this stuff is crazy expensive. And so there's always trade-offs, I guess. That's one of the other big things that I thought I was buying this relatively cheap fixer-upper that, I mean, yeah, we financially it's worked out great, but I mean, I paid for my house in numerous different ways. I mean, this house literally took years off of my life rebuilding this thing. So you pay for things in the long run. So there's no, the idea that there is no free lunch, there's a lot of truth to that. So,
well, I think it's admirable that you can do spreadsheets and build houses. I mean, that's not in my wheelhouse, so to speak. So it was pretty impressive. So I wanted to talk about another topic, but we're not going to have time for it. But maybe we'll have to have you on another time. I really want to spend some time with someone with your insights on DeFi, so decentralized finance, crypto, blockchain. The pros, the cons, the regulatory schemes, all of that stuff that I know our listeners are just going to eat up. I'm kind of being facetious. They probably don't know what any of those things actually mean because I barely know what they mean, and I've been researching this for years. So we'll have to save that for another time. I really want to do that at some point, even if it's not a podcast.
Yeah, I would love to come back and talk about it because it's such a hot topic right now. So
yeah, it really is. And it's fascinating. And there's some really cool things. And then there's some really dumb, culty things. But there's, like you said, trying to find the arguments on both sides are just stupid. But there's a lot of cool stuff in the middle, and trying to figure out what is truth, what is fake, what is
it's one of those things, kind of going back to what I was saying before. It's one of the most divisive topics. It's really hard to find people that have balanced views on it. I feel like people are either like, they're like totally anti-crypto, or they're just like, a lot of people are just like Bitcoin maximalists who are just like, it seems very hard to find people in the middle ground there.
That's been my difficulty, and which is why I can't wait maybe at some point in time to spend some time with you on it. Cause like, I get like, my best friend is so maximalist that I just can't even have conversations because it's like culty. And I'm like, listen, that's actually just not true. And so we can't have a conversation, but that doesn't mean the entire concept should be thrown out. Yeah. Anyways, we'll do that another time. Where can our listeners find your work? We keep talking about your blog, which, by the way, you are if I could only follow if I could only follow two blogs, it would be you and Morgan Housel. Where can our listeners find you? Again, where can they find your new ETF? So yeah, let's end on that.
Yeah, the blog is Pragmatic Capitalism. It's pragcap.com. And I'm on Twitter a lot. So it's Twitter, Cullen Roche, just one word. And then the company website is disciplinefunds.com. And again, I field tons of questions from people through email. You can reach me at cullenroche at gmail.com. I'm super happy to, try to help spread the knowledge. And a lot of what I do is sort of education based. So if anybody wants to reach out directly, I'm more than happy to answer questions and stuff. So yeah, those are probably the best places to reach me.
All right. And that's Roche, right?
Yep.
Roche. All right. Very good. Well, Cullen, every time you come on this podcast, I wish we had 3 hours to talk, because I could just spend endless time, but I know you're busy. We have stuff to do. Just thank you for your time. Thanks for coming on. Thanks
Yeah,
for
thank you
what you
guys. And
do.
thanks for, keep pushing on change in the 403B and 401k space. I really hope that, there's big breakthroughs in the coming 10 years, because it's a mess.
It is. And I don't know if you saw our recent news. We have, there's 14,000 odd school districts. We are trying to compile every single vendor list
I
for
saw
every
that.
single school district. Yeah. And we've got about 25% of them, 26% of them. And so many of them are just so awful that we think we can maybe shame school districts into, evolving and changing. So that's
Let's
our
do it.
goal.
I'll start publicly. I would love to start publicly shaming all these. I publicly shame a lot of high fee mutual funds. I should be shaming the administrators of these plans too, because they're really, they're really legitimately hurting retirees.
Yeah, absolutely. We'll shoot that out to you. And Scott created this fantastic grading system, A through F, and we've been I've been tweeting like an A, an F, and we'll just keep doing that. And then we're going to have our, any teacher who does, if our list is not available, you can search by state and then your district. And if we don't have your list, it's very easy for people to upload their vendor choices. So again, the goal is 100%. This is quite a task, but again, with your help, it would be fantastic, Cullen.
Yeah, I would love to help however I can.
Okay, we'll definitely stay in touch on that. Thanks again for everything, Cullen.
Yeah. Thank you guys. Thanks for having me.